Welcome, everyone, to Vested Interest. This is Shane, and this is our weekly portfolio update. I have been gone a little bit, so I am back on schedule here. Usually, we push these out every Sunday morning where we cover the stocks we bought for the week, any options I was in, dividends received as well, all out in the open. I think it's important to show what I'm doing in my portfolio, not just talking about it. Hopefully, it gives some of you out there some confidence to see that you don't have to be a financial guru. I am certainly not. I go to work every day. I have a wife, two kids. Just like you, I don't have a background in finance, so I'm doing this all on my own. Hopefully, my mistakes won't become your mistakes. You can learn something as you watch, and again, it gives you some confidence to know that you can do it too. Now, before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the channel, and a special thank you to the viewers and subscribers of the channel. You guys and gals are awesome. The channel continues to grow because of people like you. On this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, dollar cost averaging into the portfolio on a weekly basis, which is what I do, what I'd recommend you do through the ups and downs of the market. And there have been some downs in the market lately. In my opinion, it is important to continue to steadily invest, whether that's weekly, bi-weekly, monthly, once a year, whatever it is. Don't worry about what the market's doing. Control what you can control, and that's your timely investments and continued investments over time. If you would like to help out the channel, there is a way to do that. Hit that thumbs up button down below if you find any value in the content. Make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever I put out any new content. Again, I do this portfolio update typically every Sunday morning. I know last week's was a little late. I was on vacation. I am back now, again, trying to get back onto schedule here. So click that notification bell so you're notified whenever I put out any new content. I also do a a stock pick of the day video series Monday through Thursday whenever the market's open. We take a look at a company stock that's pulled back on the day, run it through my screener, see if it makes it onto my watch list. So if you're interested in that kind of content, if you're a dividend growth investor or an investor in general, make sure you click that notification bell, share with anyone you think that might find value, and there is the thanks button down below if you want to help out financially as well. Any money that I do make from the channel will go into my daughter's custodial accounts. That's what I plan on doing with the funds. All right, now that we got that underway or out of the way, let's get back to the video. All right, starting with options, nothing to report out. We did try to throw a couple of options out there on Monday, not the typical 4 or 5 or 6 that we normally do. So it was just a couple, none of them hit, neither one of them hit. So nothing to report on that front. We did have another good week in dividends. They all came from one company this week, though, $342.61 we received on March 25th from Vale. This is a mining company out of the materials sector. Funny how they broke it up into 2 sectors. I'm assuming that is because they took out some taxes and just the way they bought the shares. But total, we received, well, I'll just go through both of the buys here. It was 29, 33, 30, was it 33? Yep, 33 and some change. But we received 29.48269 on the first tranche there. And that was $298.07 of the $342.61 total. And the second one there was 4.40554 shares at $44.54. All bought on the same day, same time. Like I said, I'm assuming that whenever they paid out the dividends, the reason this was broken up was around they take out the taxes in my brokerage account with the foreign company, and this is a Brazilian company. So there are some tax implications around these foreign companies. Whether your brokerage takes it out or you are going to be responsible for it at tax time, you need to understand that. Now, the $342.61 in my portfolio, we have the drip set. So anytime a company pays dividends, in this case Vale, those funds go right back in, buy more shares of the same company. Those shares add passive income. So the passive income added from these new shares bought by the dividends is $25.12 over the next calendar year. And this is also a perfect example of the dividend snowball or compounded interest in play here, right? We own Vale. Those shares that we own and already purchased pay dividends. Those dividends buy more shares. Those shares add additional passive income. And that cycle continues every time dividends are paid out. Obviously, it grows a little faster if I add new capital along the way, but those are the way your dividend snowball will grow. The new capital you add buying those shares, the dividends paid out, The dividends that get reinvested, they buy more shares, and those shares add additional passive income. And this additional passive income will buy more shares the next time. That is the dividend snowball. Again, it grows faster when you add new capital, but even if you stop adding capital, it will continue to grow over time as long as the company grows dividends. The other way those dividends increase is when the company increases the dividend payout. All right, now we're into the first new capital deployed. We went in on the 24th and 25th. Early in the week, we were still on vacation, so I was having a bit of trouble with the connectivity there. So there's part of the reason that's broken down into a couple of days investing. Usually I don't do as much investing in and out of the portfolio as I did this week, but on Monday and Tuesday, we went and added some capital. We really added all the capital on Monday, but then, like I said, had some connectivity issues, so went back in and bought more shares on Tuesday. But broke it up into 2 days, but added it all on one sheet here so we could go over it. $1,129.96 added in new capital. With those funds, picked up 2 shares of Next Era Energy, ticker NEE. This is a utility company out of the utility sector. Picked up those shares at $71.42 per share. Lam Research, we added to that position as well. Ticker LRCX, 4 more shares there at $78.10 per share. And added to our Alphabet position, ticker GOOGL. Google is probably how you know them. Some people might call them Alphabet still. I think most people call it Google these days. 4 more shares there. It's $168.68. The new shares added an additional $11.41 in passive income over the next calendar year. We weren't done. We went back into the portfolio on March 27th. This was actually right when we got home there on Thursday. So I added an additional $464.88 to the portfolio. With these funds, I added 2 more shares to my Comcast Corporation position, ticker CMCSA. This is out of the this is out of communications sector here. 2 shares at $37.21. And then these next 2 are our weekly buys. We add to Vanguard's Total Stock Market ETF and Schwab Strategic Dividend Growth ETF. Every week, regardless of the market, I'm adding to these positions regardless of the price. So ticker VTI, that's Vanguard's Total Stock Market ETF. 1 more share there at $279.52. And 4 more shares added to Schwab Strategic Dividend Growth ETF, ticker SCHD, at $27.74. The $464.88 added, and the new shares it picked up added an additional $10.56 in passive income. And I thought I was done adding for the week, and then Friday happened. And if you were watching the market Friday, you saw a huge drop in the market overall. And like I said, I really thought I was done adding, but with that big drop on Friday, I couldn't help myself. I went back into the portfolio and added an additional $1,205.44 on Friday. With that big drop, it was just too much for me to sit on the sidelines. Even if it drops again on Monday, I had to take advantage of it. And I got some shares of Google and Lam Research for much cheaper than what I bought them for earlier in the week. We'll see that here in a minute, but let's go over the $1,205.44 I added on Friday on that big drop. Let me know if you took advantage of some buying opportunities on Friday. Like I said, huge drop overall in the market, a sea of red out there, and especially the tech companies, huge drops on the day, 4, 5, 6, 7, 8%, some 10, 14%. Big drops across the board there. So let me know what you took advantage of on Friday. But for me, I went to very heavy tech focused. Added 2 shares to my HP Inc. ticker HPQ position at $28.01 there. 2 more shares for that one. Lam Research, we added to this earlier in the week at like $78. We were able to pick up 3 more shares of Lam Research, ticker LRCX, out of the information technology sector at $72.56, so $6 per share cheaper. Google was the big one, ticker GOOGL, Alphabet there. Again, we picked this up earlier in the week at 168, those 4 shares. Well, we picked up 6 more shares of Google on Friday at $155.29. I think this even finished the week at like 154, maybe even 153. We'll see that here in a little bit. But didn't hit the low, but got pretty close with those 6 shares added to Google. And this $1,205.44 and the shares we picked up there out of the information technology sector added an additional $11.03. Again, huge drop on Friday. Hopefully you were able to take advantage of it. I've always got some cash on the side. So I maybe even should have went a little heavier, but I don't think we're done. So I don't want to go too heavy. I want to nibble as this comes down. I don't try to time the market. I don't try to time the bottoms or the tops. So I just keep on nibbling. And again, but I couldn't help myself. I had to add a little bit of extra capital on Friday. I was pretty excited. Almost added a little bit more than this. But like I said, I don't think we're done with this drop. So I'm going to try to nibble and continue to take advantage as we stair step down, which is I think what we're going to see here over the next couple of months or several months, is a continued stair step down. And that's usually how the market drops, right? It's not super often unless there's some event, a black swan event, most people would call it. Unless something like that happens, you're not going to see that huge, 25, 30% drop all at once. Typically, whenever there's market pullbacks, it's over an extended period of time, and it's typically sector allocated. You'll see sectors get hit real hard. They'll stair step down 3, 4, 5, 6 months, kind of bottom out, and then kind of turn around and start coming back up. And I think that's what we're seeing in the tech sector overall, where we're starting to see this stair step down. It's been going on over at least the last month or so. And I think that's going to continue. Now, I could be completely wrong. Tech could bottom out on Monday and skyrocket back up. That's certainly happened in the past. But I think that we're in for more of a 1998, 99, 2000, 2001, where tech really dropped off, kind of like I said, stair steps down over a 6 to 9 month period, kind of bottomed out, leveled out for a couple of years before it ever returned back to growing again. We'll see how it shakes out, but that's what I think we're going to see. Total invested $2,828. Passive income added, along with the new funds that we added and the valet dividend paid out, $58.12 in passive income over the next calendar year. All right, let's run through the sector weights here. I probably should change that from portfolio update to sector weight update, because the total portfolio update is on the next slide, but it's still all part of the portfolio update, so maybe that doesn't matter. But anyways, the sector weights, how they shake out right now: communications makes up 11.21% of the portfolio, consumer discretionary at 1.98%, consumer staples at 7.94% of the overall pie, energy makes up 8.95%, financials at 2.62%, healthcare makes up 13.68%, industrials at 6.31%, technology at 13.84%, the biggest slice of the pie there. Materials makes up 8.84%, utilities at 8.91%, REITs in real estate at 5.63%, and ETFs is 10.1% of the overall pie here. Over here to the right, you can see those portfolio sector weights, same percentages here allocated and match up with the pie allocations here, and then the dollar amounts allocated to each sector as well. And here it is. As I mentioned, I think it is important to show you my overall portfolio every week so you can see the ups and downs of building out a portfolio, the ups and downs of the market. A lot more red in the portfolio right now, actually. Even though the percent return has not really changed much, some stocks are going up, some stocks are definitely pulling back. That's the way the market goes. So again, that's why I think it's important. You'll see different sectors pull back at different times. There's often a rotation from one sector to another. Your job is to try to find, the value as those rotations happen, and they rotate out of one sector. Well, what's a good company that they're rotating out of that, may be dropping because it's just getting punished because there's a rotation? That's really our job as investors. And it's hard to see at first, but I think over time you might start to see this, especially the sector rotations. You'll start to see, 4, 5, 6, 7 different stocks in the same sector all dropping, and you may be thinking, well, what's the reason for this? Well, that could just be a sector rotation, and they often happen around market vulnerability, right? So if something's going on with the market, interest rates change, there's a war somewhere, energy prices spike because of a war, or even bad weather off the coast of the Gulf sometimes will impact drilling. They have to shut down drills for a certain amount of time because of tornadoes or hurricanes. Something like that could impact it. Bad news, again, overall prices for metals declined, might impact the material sector, for example. Technology tends to do poorer whenever we have for recessions, and companies like consumer staples tend to do better during those times. Communications tends to do better. People transition into utilities during rough times because you're going to continue to pay for your lights and your gas and heat. Uh, Oftentimes, before you're going to go out and get those consumer discretionary items like new shoes or a car or something like that. So consumer discretionary might get hit during recessions while consumer staples does well. So there's healthcare is typically seen as a defensive sector, much like utilities is. Some things like communications typically does better during that time, because same thing, I look at communications almost like a utility anymore. People are going to keep that cell phone on before they buy, again, a new pair of shoes or a third outfit or a new car. They'll fix up that old beater that they got because it's cheaper than going out and buying that new car. So there's often sectors that are impacted and that are rotated into and out of around how the economy is doing. And I think over time you can see those sector rotations. And again, it's up to us to be able to look at what's going on in the market and then look for those good companies that maybe are getting beat up for no other reason than they're tied to that sector that's getting beat up at the moment. And I think we're seeing that right now. And again, I could be completely wrong, but that is part of the reason why I show my portfolio, so that you can understand what I'm doing, why I'm doing it. I talk through it typically throughout the week, every week whenever I'm doing these portfolio updates. So hopefully some of this you're catching on as I'm doing it. But again, I'm learning as I go. So I've been showing this portfolio for 4 years, going on, a little over 4 years, going on 5 years here now. And hopefully it has benefited some of you out there. I know I'm not as flashy as some of the other channels out there, but that's okay. I'm going to keep doing my thing. And those of you who get it, get it. Those of you who don't, plenty of other YouTubers out there for you to follow. I don't take any offense to it at all. All right, but anyways, here is the ticker. All the different positions in the portfolio found in this column. Total shares. All of these numbers will be as of the close of business on Friday. So we are back on track. Again, I did miss last Sunday, put that portfolio update out on Friday. But this one will actually be up to date with all of the most recent updates that I can get for the portfolio. Total shares in this column. Current price as of the close of business on Friday. Market value of the portfolio overall here. Average cost per share. My purchase price, this does include reinvested dividends, so keep that in mind. This is not only money out of pocket, it does include anytime a company reinvests, we do have the DRIP set, dividend reinvestment plan, so that just means the automatic repurchase of those same shares of the company that paid the dividends. Total return, whether I'm up or down, you're going to see it. I want you to see the ups and downs of a portfolio, right? There could be big swings. You've seen me down 5, 6, 7, 8%. You've seen me up 8, 9, 10, 11%. I don't focus on this. It is nice to see in the green, but again, unless I sell out of all the positions in the portfolio, I do not get this total return. And unless I sell out of the positions that are in the red that are showing a negative, I don't lock in those losses. These are all unrealized gains and unrealized losses right now. I focused on the dividend returns overall, not the gains or losses. But if you focus on the gains or losses, that's completely fine, all right as well. Percent return here in this column, again, if I'm up or down, I'm going to show it. Obviously, those in the red I'm down in. The more green is the more up. AT&T is crazy that a few years ago everyone was running out of AT&T and I was running in buying AT&T, and it is my best performer right now by far. What sector each one of these companies falls in, whether they are a quarterly, monthly, semi-annual payer. Current dividend yield as of the close of business on Friday, my yield on cost is starting to go down a little bit, but that is the nature of the portfolio. Also, as the positions in the portfolio raise their dividends, hopefully we get that yield on cost back above 4%. Portfolio weighting here in this position, estimate, let me talk about that. For portfolio weighting, I do have a bit of a rule in the portfolio. I don't want any one sector besides ETFs, because ETFs I add to every week. So eventually ETFs are going to be the biggest part of the portfolio. That's just the nature of adding to something every single week, regardless of the market conditions. So, but for sectors outside and individual positions outside of ETFs, I do not want any one individual stock position to be more than 10 to 15% of the portfolio, right? If a stock, for example, was around 8, 9, 10% of the portfolio, and then it had a big run up and maybe it became 12, 15% of the portfolio, it doesn't necessarily mean I'm going to sell the position to bring it back in line. It just means I would stop adding to it and pick out other sources in the portfolio to add to, right? So it doesn't necessarily mean I'm going to trim the positions to maintain those weights, but it will impact whether I'm adding to a position or not. And I don't want any one sector to be more than 20 to 25% of the portfolio. Same thing right now, for example, healthcare is really down, right? Johnson & Johnson is still up, right? Johnson & Johnson's up 10%. But CVS, that's up slightly, 4.13%. This is one that is crazy. It was down, 15, almost 20% here just a month and a half ago. Now it's come back. You can see that. See, that would be an example of a rotation in sectors. It seemed like a lot of people, J&J was down about the same time, and it seemed like people were rotating out of healthcare. Then all of a sudden, with some of the craziness in the market, it looks like this is a defensive sector. Healthcare is. People are going to take care of themselves. You have to go to the hospital whenever you have to go to the hospital. That's just the way it is. And about a month and a half ago, I would say there was a rotation definitely into CVS and the healthcare sector overall. So it brought back CVS, it brought back Johnson & Johnson. Now it hasn't brought back Pfizer. That's still one that's struggling. But overall, that was one that was rotated into here not too long ago. But anyways, what I was getting at is healthcare, for example, is still down, especially with Pfizer. And it is around 10% of the portfolio. But let's say it was closer to 20. And then there was a big run up in Pfizer. There was a big run up in healthcare overall. I would let the healthcare sector overall maybe run past that 25% allocation if it was because of a big run up in the sector. But then I wouldn't add to that sector. So that's how I use the weighting. I don't want any one position to be more than 10% of the portfolio, 10 to 15%, let's say. I don't want any sector to be more than 20 to 25% of the overall portfolio. And again, that does not include the ETFs. ETFs, individual positions, right now SCHD, for example, is 4.8% of the portfolio. Well, if I continue to add to SCHD over and over every week, regardless of the market conditions, eventually this will be more than 10% of the portfolio. Same thing with VTI. It's 5.3 right now. If I continue to add every week, regardless of the market, while I'm splitting the rest of the funds over these other 30 or so positions, eventually VTI is going to become a larger than 10% of the portfolio. So I don't include VTI, SCHD, and ETFs in general in that rule. Okay, hopefully that made sense. Estimated annual income in this column, that's really my focus. Payout months here. Dividend growth year over year, you can see that's at 5.85%. I have quarterly, monthly, semi-annual payers here. I did increase or note the increases in dividends in several different companies. Enterprise Product Partners, for example, recently raised their dividend, so I've got that one locked in now. SCHD, their raise. And I know everyone's calling it a raise, and it is year over year. From this time last year, it is a 22.1% raise, whatever it was, 22. I just put 22%, it's close enough. But technically, from the last payout of last year, it's actually down. It was 26 cents and some fractions of a penny, the last payout. So it's actually down from that one, though it is up from this time last year. It was around 20 cents this time last year. So that's where you get the 22%. It's actually a 22% increase year over year, not an increase from last payout. Last payout, again, was around 26 cents per share. So this actually brought my overall payout down slightly when I increased this one, or really decreased this one, increased it from last year's payout, but decreased it from the last quarter's payout. Now, VTI, they also increased their dividend here, so I've got that one locked in. So the most recent changes, again, Enterprise Product Partners. So we've got that one highlighted now. SCHD. Now, SCHD I've highlighted. I'll adjust this as they change from quarter to quarter here, because that will adjust slightly from quarter to quarter. That's how their payouts are done. You're really looking at, again, year over year changes. So from this time last year, it's up 22%. And then same thing with VTI. They will adjust from quarter to quarter their payout. Typically, their one in the beginning of the year is a little lower than the rest. So this, I imagine, by the end of the year will actually be over $1. We'll see. It should be pretty close to that. But those are the most recent updates as far as dividend payouts. Payout months, we mentioned dividend growth year over year, so we're at 5.85%. That did increase our dividend growth year over year with those adjustments. And where a company sits at 15% of a 52-week low. Let's look at Google. Huge drop on Friday. Wow, what a drop on Friday. Like I said, buying it at $68 per share at the beginning of the week, or 168 per share, was able to get it at 155 at the end of the week. That is how big of a swing we saw in overall the technology sector this past week, just this past week. HPQ, same thing. I was able to pick up these the day before Friday at around $28 per share, and they were under the $28 per share. So very, very interesting. This did adjust what I'm looking to focus on for purchases on in April. If you haven't seen that video, I put that one out yesterday. 4 stocks that I'm going to be focused on in April. Google is still on that list. HPQ joined that list. Now they're in the red. They're solidified in the red with the pullback in tech stocks. Go check out that video for the other 2 if you haven't seen it yet. All right, let's wrap this one up here. I'm getting a little long-winded. But anyways, total shares, 7,100.454 shares. Market value of the overall portfolio, $347,544.22. I do have $323,960.98 out of pocket. Again, does include reinvested dividends. If I had the drip turned off, those dividends would go in my pocket. That's why I say out of pocket. Out of pocket also includes, weekly infusions of cash literally out of my pocket, out of my paycheck that I add every week. That's part of the portfolio update that we look at. The purchased shares are coming out of my weekly paycheck, bi-weekly paycheck really. I just break it down, cut it in half over 2 weeks. Total return here, $23,582.24. Nice to see that I'm still up, and still up even with the craziness in the market and the huge drop in the tech sector because of the raises in some other sectors, like communications, for example. Verizon's up 9.27% all of a sudden, right? AT&T is screaming. So there's that rotation that I was speaking of, right? It seems like everyone was out of communications last year. It was a sector no one really wanted to be in. AT&T wasn't up 64%. Verizon was still in the red at times. Now all of a sudden people seem to be Comcast. I think we were down 13 or 14% here just a week and a half ago. Now that we're down still, but only 7.5%. So there seems to be a rotation into communications. Utilities, same things. AWK up 21%. If you were watching the channel, I actually added to AWK about a month ago, right? They were right around $120 per share is when I was adding to them, right around my cost basis. I think I might even got them a little bit lower than my cost basis at one point. But right around just above my cost basis is where I was adding to them a month and a half ago. NextEra Energy has had a bit of a pullback. We've been adding to that one there. But overall, the utility sector, the communications sector, the other one is, where is it? Consumer staples seems to be another one people are rotating into. Procter & Gamble's up 10.75% still. Healthcare, like we mentioned, seems to be one people are rotating in. Johnson & Johnson is back up by 10%. CVS, like I said, is back up 4.13%. This one, just a month and a half, 2 months ago, we were down 15, 16, almost 17% at times. So there definitely seems to be a sector rotation. Energy is another one people seem to be rotating into. Enterprise Product Partners is up 31.44%. Enbridge is up 18.76%. Oxy, we're still down a little bit, but this is one I really wanted to continue to add to. If you saw here, we were adding to this in the $44, $46 range. So it's kind of turned around a little bit. SYY, another one out of the consumer staple sector, up 6.42%. But anyways, this is what, again, I know I keep going back to it. We're starting to see some sector rotation. Tech seems to be one people are rotating out of. Consumer staples, healthcare, energy, utility seems to be what people are rotating into. That just seems to be, even SCHD, if you look at their reconstitution, a lot more energy now. Consumer staples seems to be, they increased their overall allocation to consumer staples. They increased their overall allocation. Energy is now the largest sector in that one. So they even seem to be doing a bit of a rotation. And hopefully you're starting to see that now that we're been in the market, or you've been in the market 4, 5, 6, 7 years, should be able to start to see that a little bit. But anyways, we went over the percent return. Current yield 3.723%, yield on cost 3.99%. And this estimated annual income, this is what I'm really focused on, continues to go up week over week, month over month, quarter over quarter as I add new capital, as the positions in the portfolio increase their dividends, as they pay their dividends, and those dividends get reinvested and buy more shares. And currently sits at $12,938.11. I think we are going to bust over 13,000 sometime in April, if not this coming week, definitely in the month of April overall. And I would really like to see the overall portfolio paying out 16,000 or more by the end of the year. That is really my goal. I think it's doable. That would be a little over 3,000 more in dividends in estimated annual income over the next, what is it? It's March, almost April, over the next 8 months. So we'll see, but I think it's doable. I think we can add another 3,000 in annual dividend incomes over the next 8 months, especially if the market continues to pull back and we can get some of these buys at cheaper prices. Dividend growth year over year at 5.85%. Let me know if you have any questions. Sorry, I rambled a couple different times there. Again, I think sector market rotations is what's going on right now. There is going to be a pullback, so you should see a big pullback in some sectors, rotating into, we'll call them more defensive sectors. And those defensive sectors, usually when we have recessions, healthcare, again, if you break a leg, it's not something you can not go to the doctor about, right? You're going to go to the emergency room, you're going to get taken care of. So healthcare tends to do well. Utilities, same thing. And really, you wanted to be in these before the run-ups, right? So this is why I'm looking at, we're on the flip side of that now. If you weren't in healthcare, you weren't in energy, you weren't in consumer staples before we started to see this rotation, now what I would do is I'd look on the back end, which is what I'm doing. And where are the pullbacks happening? Well, the pullbacks right now are really happening in tech. So I'm focused on buying Google, HPQ, still want to hit some LRCX, right? As those big pullbacks in those sectors happen, that's whenever you want to jump in. If they're good companies, if the fundamentals are sound, if they're paying down debt, their revenue's still growing, their margins are still expanding, they're good companies, those rotations, when they're pulling out of those because of market downturns, that's when I like to buy. And then I let those other sectors that people are rotating into that I've already been in, right? I was buying utilities a month and a half, 2 months ago. I've been buying Comcast. I bought a bunch of Verizon here not long ago. AT&T I was buying last year whenever everyone was running away from it. That's why I'm up 64%, right? I'm trying to buy when everyone else is running away. Pfizer. No one likes Pfizer right now. I'm probably going to be adding to Pfizer. Occidental. No one was really adding to or talking about Occidental. I was adding to it here over the last couple of months, right? Building 206 shares over the last several months. So I want to be in the sectors people are running away from. Owens Corning Industrial seems to be another sector people are running away from. This is on my list to add to over the next month, at least in April, even though I'm up 25.04%, right? I was up 90% on this 2 months ago. So it's pulled back, really pulled back. So I want to build this back out again while it's down. Union Pacific, same thing, seems to be down. I was up 20, 30% here a month and a half ago. So it looks like, along with the tech sector, industrials is another one people are rotating out of. Materials looks like another one that people are rotating out of. I might be adding to Valet. Materials, I'll probably be adding some more to Nutrien. Right? So when there's rotations like this, you can take advantage of it. That's what I'm getting at. You can buy in those good companies people are rotating out of, let the other people kind of run those other sectors up, and you take advantage of that sector rotation as it happens. That's what I'm looking to do. Maybe I'm wrong. Maybe I'm absolutely wrong, but so far it seems to be working out okay. And again, I think it's important to show a portfolio so you can see what I'm doing, learn from my mistakes, maybe copy what I'm doing right, but you can do it too. You don't have to pay someone to manage your portfolio. I do not have a background in finance. I do not have a background in building portfolios. I don't have a degree in it, certainly. I'm learning along the way, and hopefully you are learning something watching the channel. All right, I've gotten long-winded. I'm going to cut it off there. That is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think of the video. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. Let me know what you're buying. Crazy drop on Friday. Did you take advantage of it? Can you see the sector rotations that I'm talking about? Does that even make sense? If you got any questions about that, drop them in the comment section down below. I'll try to talk through them a little bit more, or maybe I need to do a video specifically around sector rotations and market rotations that make more sense. I've done one in the past, but my channel was extremely small then. I only had maybe a couple dozen viewers, so maybe I need to resurrect that and go over it again. Let me know if you'd like to see that video down in the comment section. I'll try to put one together here. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend. Hopefully you are finding the value in this crazy market out there. Let me know what's going on in your portfolio. How are you doing? Don't panic sell. If they're good companies, just because they're in the red doesn't mean you need to sell. Maybe it means you need to double down if they are good growing companies. You've done your due diligence. You know they're good companies. They're growing their margins. Their revenue is still growing. And you see those red days. Those are the days you want to buy more shares. Don't sell just because you're scared or just because of stock drop. If it's a bad company, you don't know what you bought, then maybe it's a reason to sell. But don't sell just because something pulls back. All right. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Invest your educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.